Imagine the scenario. You're walking a tightrope, a literal tightrope, suspended high above a canyon.
Okay.
Beneath you is a chasm of absolute economic uncertainty. On your left, you have the world's largest economy, the United States, throwing up tariff walls and, well, igniting trade wars that are shaking the very foundations of global commerce.
Right. It's chaotic.
On your right, you have an artificial intelligence sector that is growing so fast, it's frankly terrifying investors who think it might just be a massive bubble waiting to burst. The wind is just howling with policy conflicts, geopolitical tension, diverging monetary policies.
It's the perfect storm.
It is absolute chaos out there. And yet, amidst all this noise, amidst all this fragility, one major economy isn't just surviving on that tightrope, it's running across it. It's actively pushing the growth frontier. We're talking about a 7.4% expansion while the rest of the world is scrambling just to find a foothold.
It is a striking, almost poetic contrast, isn't it?
Yeah.
And what we really need to understand right off the bat, before we even look at a single chart, is that this isn't just a lucky streak.
Not a one-off.
No, not at all. This isn't a statistical anomaly or some bounce back from a bad year. This is what the Ministry of Finance is explicitly calling a structural shift. We're looking at a scenario where India's potential growth, think of it as the maximum speed limit of the economic engine without overheating, has been upgraded to 7%.
Upgraded, that's a key word.
It is. But the real story, the one we're going to dig into today, is how we got here while a global storm is raging outside.
Exactly. That is the mystery we're solving today. Welcome to this deep dive presented by the Simplified UPSC by PPP YouTube channel. I am so thrilled you're here with us. We have a massive task ahead of us today.
We certainly do.
We're breaking down the primary document for the Indian economy, but we are going to make it accessible and, dare I say, genuinely interesting.
It certainly is a massive task.
Yeah.
We're dissecting, really, the Bible of the Indian economy. For an aspirant, this isn't just a report. It's the source code for the next year of exams.
Yeah.
It's everything.
Before we crack open this massive chapter, I have a humble request for you. If you find value in this analysis, if this helps you connect the dots between theory and reality, please subscribe to the channel.
It really does help.
We're building a community of serious learners here, and we want you to be a part of it.
And if you are capable, please consider joining the paid membership on YouTube. Your support is the fuel that keeps this high-quality, super useful content coming. It allows us to go this deep into the material without cutting any corners.
Absolutely. A massive shout out to all our existing members. You are the backbone of this channel. We see you. We appreciate you. Please like this audio and share your valuable comments. We read them all, and we love seeing the discussion in the comments section.
And for the serious aspirants listening, do not forget that free notes with practice previous year questions, or PYQs as we'll call them, are waiting for you on our Telegram channel. You need those notes to revise what we talk about today. You really do.
Yeah.
And for our Legend YouTube members, check the Discord channel. That's where the premium notes, the extra PYQs, and crucially, the Model Mains Answers live. Do not miss out. Join us there.
Okay, so the roadmap. What's our mission today?
Our mission is a line-by-line comprehensive analysis of the Ministry of Finance's Economic Survey 2025-26. We are laser-focused on Chapter 1, State of the Economy, pushing the growth frontier. And when we say comprehensive, we mean it.
No skipping the hard part.
Not a single one.
That's right. We have a no-omission rule today. We are covering everything. The global fragility, the domestic trends, that fascinating new Nowcasting model the government is using, inflation dynamics, and of course that upgraded growth outlook.
And to make this practically useful for your exams, we will be integrating relevant previous year questions from 2013 all the way to 2025. We want to show you how this material, this very chapter, directly answers some of the toughest UPSC questions.
So let's dive in. Let's start with the big picture. Section 1 covers global economic growth. The survey describes the world with two very specific words: fragile and diverging.
And that's putting it mildly.
Since the last survey, the world has seen some major disruptions. The elephant in the room is obviously the U.S. tariffs on imports imposed in early 2025.
It was a significant move, essentially shifting the tectonic plates of global trade. In April 2025, the U.S. announced these, reciprocal tariffs. Now, naturally, the immediate fear, the standard economic textbook reaction, was that global growth would just collapse and inflation would spike everywhere.
Right. If you tax trade, trade slows down, prices go up. Simple, right?
That's the logic. But the data shows something different. Something counterintuitive happened. That collapse didn't happen immediately. The question is, why? Why did the global economy keep chugging along?
This sounds like a behavioral economics puzzle.
It is a classic case of behavioral economics. U.S. households and businesses, well, they aren't robots. They saw the tariffs coming. They read the news.
They anticipated it.
Exactly. So what did they do? They front-loaded their spending. Businesses rushed to export goods to the U.S. before the tariff deadline hit, and consumers bought cars and electronics before the prices went up.
So it was a temporary burst of activity just to beat the clock. Like a going out of business sale, but in reverse.
Precisely. That's a great analogy. It created a temporary illusion of growth. If we look at the IMF's World Economic Outlook projections from January 2025 to January 2026, advanced economies, or AEs, actually stabilized better than feared.
But you're saying it's fragile.
We have to be very careful here. This stability is incredibly fragile because that front-loading effect wears off. Once you've bought the new car, you don't buy another one next month. The bill eventually comes due.
And there's another massive factor driving the U.S. economy, right? We can't talk about 2025 without talking about the AI factor.
This is a staggering statistic that you should probably note down. Investment in artificial intelligence accounted for nearly half of U.S. GDP growth in recent quarters.
Wait, say that again? Half?
Half. Think about that for a second. Half of the growth of the world's largest economy is being driven by investment in one specific technology sector.
That is incredible. I mean, it sounds like a boom, but it also sounds suspiciously like a bubble.
That is the risk the survey highlights later on. It's the AI sugar high. It feels great while you're eating it, but is it building muscle or just fat? For now, it's keeping the U.S. numbers up.
But that's not the story everywhere.
No, not at all. If we look elsewhere, the story changes completely. Europe is a mixed bag. Germany and Italy are seeing very moderate growth, while Spain is actually outperforming.
And Asia.
Asia is struggling with divergence. This is where the diverging part of the chapter title really comes in. China is facing deflationary pressure. Prices are actually falling, and they are still dealing with a massive property crisis.
Which is a huge drag on their economy.
A huge drag. Meanwhile, Japan is struggling with the opposite problem. Inflation that is consistently above their target. So you have the U.S. on an AI sugar high, China in deflation, and Japan in inflation. It's a messy, messy picture.
Which leads us to monetary policy. The central banks must be pulling their hair out trying to manage this divergence.
They are all moving in different directions, which is a nightmare for global stability. The survey calls this diverging monetary policy. We are shifting from that period of aggressive tightening, raising rates to fight inflation, to a more neutral or even accommodative stance.
Yeah.
But if you look at charts 1.1 and I.2 in the survey, the policy rates are just all over the place.
And what does that do to global money? Why should an aspirant in India care if the Fed and the Bank of Japan are disagreeing?
Because money is liquid. It's like water. It flows downhill. It hunts for yield. If the U.S. has high interest rates and Japan has low rates, money flows violently from one to the other.
And that creates volatility.
Massive volatility. It causes the rupee to fluctuate. It creates instability for emerging markets like ours. And on top of that, if you look at chart 1.3 in the survey, it highlights that fiscal deficits, the amount governments are borrowing, are still higher than pre-pandemic levels. So you have fiscal indiscipline on top of monetary chaos.
This reminds me of a specific previous year question. It feels very familiar.
Yes, let's connect this. Look at 2022 CSP Q3. The question was about trends in U.S. and EU interest rates and how they induce the RBI to buy dollars.
Right.
The logic was, when global rates diverge or rise, capital flows out of markets like India to go to the U.S., putting pressure on the rupee. The RBI then have to intervene, selling dollars to prop up the rupee. The survey is describing exactly the environment that makes that question relevant today. The mechanics haven't changed, even if the year has.
And there was a mains question about fiscal discipline too, wasn't there?
Correct. 2013 GS3 Q2 asked about the FRBM Act, the Fiscal Responsibility and Budget Management Act. The context then was the need for fiscal discipline. The context today, as per the survey, is that while the world is being fiscally undisciplined running these high deficits, India is sticking to its path of consolidation. That contrast is India's strength.
So the world is borrowing to survive, but India is consolidating to grow.
That's a very good way of putting it.
Let's talk about uncertainty. The survey mentions that policy uncertainty is at historic highs. I'm looking at chart 1.5, and the graph is just spiking.
It is, and uncertainty is the enemy of investment. It's poison. If you don't know what the tax rate will be next year or if a war will break out, you don't build a factory. It's that simple.
And the numbers back that up.
They do. Global foreign direct investment, or FDI, declined by 11% if you exclude conduit economies. That's a sharp, sharp drop.
But wait, didn't the U.S. see an increase in FDI? That seems contradictory.
Yes, and that's the friendshoring phenomenon in action. U.S. FDI rose 19.7%, largely driven by chips and AI. But this isn't free market efficiency. This is political. The world is moving money into safe or friendly jurisdictions, not necessarily the most efficient ones. It's a geopolitical calculation now, not just an economic one.
This brings us to one of the most fascinating parts of this chapter, Box I.1. It's titled The Resurgence of Economic Statecraft. Sounds like something out of a history book.
This is a must-read section. I'd say if you only read one box in this entire chapter, read this one. It unpacks the concept of strategic resilience and indispensability. Essentially, the survey argues that the era of seamless globalization, where we just buy from whoever is cheapest, is over.
So it's replacing it.
A world driven by ultra-nationalism and a deep skepticism of free trade. The survey uses a beautiful geological metaphor here to talk about creation and subduction zones.
Well, it's tectonic plates.
Exactly. Just as the Earth's crust needs a balance between creation of new crust and destruction of old crust, the global economy needs a balance between surplus nations and deficit nations. When that balance breaks, you get earthquakes.
And in the economic world, those earthquakes are trade wars and weaponized supply chains.
Precisely. The world is moving from efficiency, buying the cheapest goods, to security, making sure you can get the goods even during a war or a pandemic. We are seeing the weaponization of trade, of finance, of everything.
How does this link to our exams? This feels very geopolitical, very GS2.
It links directly to 2016 GS2Q17. That question asked about the WTO's aims versus the reality of the Doha round and rising protectionism. The survey is essentially providing the answer to that question for 2026. It's admitting that the WTO's ideal of open trade is being dismantled by this new economic statecraft.
So the old rules don't apply?
They don't. It also links to 2013 GS3Q7, which asked about the impact of liberalization on Indian companies. The game has completely changed. Indian companies aren't just competing on price anymore. They have to navigate these complex geopolitical barriers. You can be the cheapest steel producer in the world, but if there's a tariff wall, you can't sell.
Okay, that is the gloomy global backdrop. The world is fragmenting, tariffs are rising, and money is volatile. Now, let's pivot to the star of the show, India, Section 2, Trends in the Domestic Economy.
And here the music changes completely. The headline number is 7.4%. That is the real GDP growth projected in the first advance estimates for FY26.
That's massive. Let's break it down. Where is this growth coming from? Is it one sector or is it broad-based?
It's quite broad-based. If we look at the supply-side gross value added, or GVA, it's growing at 7.3%. The heavy lifter, as usual, is services at 9.3%. Services are the engine of our economy. But the real surprise, the positive shock, is manufacturing.
Manufacturing is growing at 8.4%. That feels like a significant jump from what we've seen in the past.
It is strong, sustained traction. We've been trying to boost manufacturing for decades, Make in India, PLI schemes, all of that. Seeing it hit 8.4% suggests that those policies are finally biting. They're getting some real grip.
And agriculture.
Agriculture is stable at 3.6%, which is actually pretty decent considering the structural constraints and the vagaries of the monsoon. It's providing a solid floor.
Why is that manufacturing number so important for an aspirant to understand?
Because it relates to the structural transformation of the economy. Think about 2020 GS3Q7, which asked about the location of the iron and steel industry. When manufacturing GVA rises like this, it implies a shift in industrial location, in raw material usage, in logistics. It's not just a number.
It's a physical change on the ground.
Exactly. And also, 2013 GS3Q8 asked about land reforms and productivity. You cannot sustain 8.4% manufacturing growth without addressing land and labor productivity. The survey is signaling that the industrial engine is finally firing, which changes the nature of questions you might face on industrial policy.
Here is where it gets really interesting for me. Let's talk about the demand side, specifically consumption. Who is buying all this stuff?
Right. This is private final consumption expenditure, or PFCE. This is the money you and I and everyone else spends. And it has hit a major milestone. The PFCE share of GDP is now 61.5%. That is the highest it has been since FY12.
That is a long time. FY12 is over a decade ago. Why is consumption surging now? I mean, there was a lot of talk about a K-shaped recovery where the poor were hurting.
The survey actively counters that narrative. It argues for a broad-based recovery. Why? A few reasons. Inflation is low, which leaves more money in people's pockets. Real purchasing power is rising. Employment is stable. But the most encouraging sign, the data point that really stands out, is from rural India.
The NABARD survey.
Yes. The NABARD All India Rural Financial Inclusion Survey. It's a credible source. It shows that 79.2% of rural households reported an increase in consumption.
That's a huge number, almost 80%.
It completely destroys the narrative that rural India is in deep distress. It suggests that the recovery isn't just for the urban rich in their high-rise apartments. It's reaching the villages.
I recall a question about financial inclusion from a few years back.
2015 CSP Q1 regarding the Pradhan Mantri Jan Dhan Yojana. And you see, this is the connection. You cannot have this surge in rural consumption without the financial architecture to support it. Jan Dhan, direct benefit transfers, DBT, these mechanisms have put money directly into rural hands, fueling this 61.5% number. It's a direct cause and effect.
So the plumbing that was built over the last decade is now delivering water.
That's the perfect way to describe it.
What about investment? Are companies putting their money where their mouth is? Is this just consumption, or is it also investment-led growth?
It's both. Gross fixed capital formation, GFCF, is maintaining a share of about 30% of GDP. This is a very healthy number. And more importantly, we are seeing the crowding in effect in action.
Remind our listeners what crowding in means. It sounds counterintuitive because we always hear about crowding out.
Right. Often people worry that if the government spends too much, it crowds out private investment by using up all the available capital or driving up interest rates. Crowding in is the opposite. It's when public investment acts as a catalyst for private investment.
Give me an example.
The government builds a new highway, public capex. And because of that new highway, a private company decides it's now viable to build a factory next to it. The public investment makes the private investment possible. The survey clearly states that private corporate capex is responding to this sustained government capex push.
And we see this in real estate too, right? The survey mentions sales in top 8 cities grew 20% year on year.
Exactly. Construction is a huge job creator. It absorbs labor moving out of agriculture. This links back to that structural transformation we were talking about. It's all connected.
Let's touch on exports briefly. Global trade is tough, as we discussed at the start.
It is, but India's exports still grew at 5.9% in the first half of the year. The anchor here, the real hero of the story, is services exports. They are consistently offsetting the volatility in goods exports.
So when tariffs hit our physical goods, our services can still get through.
Exactly. When tariffs hit goods, services like software, consulting, R&D often slip through the cracks and keep growing. This is a classic case of services-led export growth, and it's a huge source of resilience for us.
Before we move on to the next section, I want to highlight the supply side of agriculture again. You mentioned it, but the survey calls it a silver lining.
It does. Specifically, it points to the shift to allied sectors, livestock, and fisheries.
This connects perfectly to 2013 GS3Q6, right? The pink revolution.
Spot on. That question asked about the pink revolution in the food industry. The pink revolution refers to the meat and poultry processing sector. The survey is explicitly stating that these allied activities are buffering crop volatility. If the monsoon is bad, crops might fail, but your livestock can still survive and provide income.
So it's a de-risking strategy.
It's a massive de-risking strategy for the rural economy. This diversification is exactly what the pink revolution aimed for. It's proof that the policy direction from a decade ago is bearing fruit today.
Okay, moving on to Section 3. This is something new and very tech-heavy. Box I.2. Nowcasting India's quarterly GDP growth.
This is fascinating stuff. Usually official GDP data comes with a lag of about 2 months.
Which is an eternity in today's economy.
It's like driving a car while looking only in the rearview mirror. You're steering based on where the road was, not where it is. In a volatile world, that's incredibly dangerous. You need to know what's happening now.
So how does nowcasting work? How can they know the GDP before they've collected all the data?
They use what are called high-frequency indicators, things we can measure daily or weekly. Think about electricity consumption, railway freight traffic, GST collections, toll collections on highways.
So the pulse of the economy.
Exactly. They give you a pulse of the economy in real time. They then feed all these different data streams into a sophisticated statistical model.
The survey mentions a dynamic factor model and principal component analysis. Can you decode that for us in simple terms?
Let's try an analogy. Imagine you are at a very loud party. There are 50 different conversations happening at once, people talking about sports, weather, politics. It's just noise. Principal component analysis, or PCA, is like a special hearing aid that filters out all the background noise and isolates the 1 or 2 clear conversations that actually matter. the signal.
Ah, so it finds the signal in the noise.
Precisely.
Yeah.
It takes 50 different indicators and condenses them into a few factors that actually explain the movement of the economy.
And they use a scree plot to do this. I'm looking at chart 1.19.
Yes, a scree plot is just a visual tool that helps them decide how many of these signals or factors they need to track to get an accurate picture without getting overwhelmed by the noise. It tells them if they need 2 factors, or 3, or 4.
And the prediction model itself is called Arimax?
Yes, ARIMAX. It stands for Autoregressive Integrated Moving Average with Exogenous Inputs. It sounds like a mouthful, but let's break it down.
Please.
Autoregressive means it looks at past trends. If the economy was growing yesterday, it's likely growing today. Individuated moving average is a way to smooth out random fluctuations. And the X for exogenous inputs is the key part. It means it looks at outside shocks, like global oil prices or those U.S. tariffs we talked about. It combines history with current events to predict the immediate future.
So, drumroll, what does the machine say?
The machine predicts 7% real GDP growth for Q3 of FY26.
Which confirms that the momentum we're seeing is sustaining into the next quarter.
Exactly. And more importantly, this marks a fundamental shift in governance. We are moving from periodic, backward-looking data collection to a continuous, technology-enabled statistical system. For a UPSC aspirant, this is a prime example of e-governance and data-driven policymaking. It shows the state's capability is upgrading.
Let's talk about the fundamentals. Section 4, Assessment of Domestic Macroeconomic Fundamentals. Let's start with the big one, inflation.
The survey uses a very strong word here, tamed. Headline CPI is at 1.7% for the period of April-December FY26.
1.7%. That is way below the RBI's 4% target. That's almost too low. Are we in danger of deflation?
It is very low.
Right.
But we have to look under the hood at the breakdown. It's driven largely by a sharp disinflation in food specifically. Vegetables and pulses prices dropped significantly. So the supply-side management for food really worked.
But I still feel like things are expensive. If I go to the store, prices don't feel 1.7% lower.
And that's the crucial difference between inflation, which is the rate of change, and the overall price level. Prices aren't falling generally, they just aren't rising as fast as they were before. However, the survey does note that core inflation, which excludes volatile food and fuel, appears sticky. It's not dropping as fast as food inflation did.
So the underlying pressure is still there.
It seems so, but the survey adds a fascinating twist here.
The gold and silver twist.
Yes. Core inflation includes items like personal effects, which includes gold jewelry. Gold and silver prices have surged globally because of all that uncertainty we talked about at the beginning. People are fleeing to safe havens. So if you exclude just gold and silver prices from the core inflation basket, the underlying inflationary pressure is actually very soft. The stickiness is being imported through gold prices, not generated domestically.
The survey also mentions the base effect. We need to explain this because it comes up in exams all the time and it can be confusing.
It's a simple concept that sounds complicated. Imagine you are measuring your height. If you grew a lot last year and then you grow a normal amount this year, your percentage growth this year looks small because you're comparing it to a very tall base from last year.
Right.
It's the same with inflation. If prices jumped very high last year, creating a high base, then even if they stay high this year, the inflation rate, which is the percentage change, will be low. The survey says this high base effect from the previous year was a major factor that helped pull the headline inflation number down to 1.7%.
I'm thinking of 2015 CSP Q87, which asked about who is responsible for controlling inflation.
That's a great link. The question was, is it the government or is it the RBI? This situation illustrates perfectly that it's a partnership. The government handles the supply-side measures, like releasing onion stocks, cutting import duties on edible oils, or boosting pulse production. That's what brought food inflation down.
And the RBI handles the demand side.
Exactly. The RBI handles monetary policy interest rates to manage overall demand. The fact that food inflation dropped, supply side, while core inflation remains sticky before you account for gold, demand monetary side, shows how these two forces interact. You need both blades of the scissors to cut inflation. 2022 CSPQ3 also touched on this interaction regarding the RBI's role.
Let's look at the government's checkbook, fiscal stability.
The survey is very optimistic here. It says we are on a fiscal glide path. The target is a 4.4% fiscal deficit by FY26, and the government is confident they will hit it.
Why so confident? Are they collecting enough taxes?
More than enough. Direct tax collections were already at 53% of the budget estimates by November 2025. GST collections are hitting all-time highs month after month. This is what economists call revenue buoyancy. When the economy grows, tax collection grows even faster because compliance improves and formalization increases.
And where are they spending this buoyant revenue? This is the crucial part for quality of expenditure.
Capital expenditure. This is the quality shift we need to underline. The central government's capex share rose from just 12.5% in FY20 to 22.6% in FY25.
That's nearly double.
Nearly double. They're spending on assets, roads, bridges, railways, ports, not just on consumption subsidies. This is building the future economy.
This validates the spirit of the FRBM Act, doesn't it?
Completely. 2013 GS3Q2 asked for critical analysis of the FRBM Act. The whole goal of that act was intergenerational equity, it said. Don't borrow to consume today, borrow to build for tomorrow.
Because if you borrow to pay salaries, you leave debt for your children with no corresponding assets.
Precisely. But if you borrow to build a railway, you leave debt but also an asset that generates income for decades. The shift to 22.6% capex is the FRBM Act in action. It also links to questions like 2020 GS3 Q14 about infrastructure and interlinking rivers. These massive projects are only possible because of the sustained capex push.
And the world is noticing. The survey mentions 3 ratings upgrades in 1 year.
Yes. S&P upgraded India to BBB, CareEdge to BBB, plus SEER. These are significant votes of confidence from global markets.
Why does a rating upgrade matter to the common man? I mean, does it change the price of milk?
Indirectly, yes, it can. It lowers borrowing costs for the entire country. When the sovereign, the government, is seen as safer, the interest rate on government bonds drops. Since all other loans in the economy, home loans, car loans, corporate loans, are benchmarked against government bonds, the risk premium on India as a whole drops.
So it could mean cheaper loans for everyone eventually.
That's the transmission mechanism. It also signals to the world it is safe to park your money here. It attracts more stable, long-term investment.
Okay, Section 5, Outlook and Way Forward. After all this analysis, what does the future look like?
The survey calls FY27 the year of adjustment. It acknowledges that FY26 was tough externally, and FY27 will be about adapting to this new, more fragmented normal.
So the global outlook is still pretty dim.
Very dim. The survey explicitly warns about AI bubble risks. It asks the question we asked earlier, what if that AI investment in the U.S. doesn't yield real productivity gains? What if ChatGPT doesn't actually make companies more profitable? The stock market could crash, trade conflicts could worsen. But, and this is the key phrase, India is described as internally strong.
We have buffers. We have shock absorbers.
Exactly. Healthy balance sheets, banks are profitable, corporates have low debt, low inflation gives the RBI room to maneuver, high forex reserves. These are the shock absorbers. We can take a punch from the global economy.
Now, box I.4. This is arguably the most important takeaway for the long term. Reassessing medium-term potential growth.
This is the headline for the future. The survey has officially upgraded India's potential growth estimate from around 6.5% to 7%.
That's a big jump in economic terms. That half a percentage point is huge over a decade. How do they justify it?
They use a production function equation. For the math nerds listening, it is based on the Solo growth model. The equation is delta ln a plus alpha delta ln l k plus 1 alpha delta ln l day.
Okay, let's unpack that into plain English before our listeners panic.
Right. It's much simpler than it sounds. It just says that economic growth, Y, comes from 3 ingredients. First, capital K, which is your machines, roads, factories. Second, labor, L, the number of workers and their skill level. And third, total factor productivity, A, which is the magic sauce.
So let's break down each of those 3. Why are they improving?
Okay, so capital K is growing because of the improved efficiency we discussed in that massive public capex push. Labor, L, is contributing more due to better skilling initiatives and greater inclusion, like more women entering the formal workforce. But the magic variable, the one that's really changed the game, is A, total factor productivity.
That's the secret sauce, right? It's the stuff you can't measure directly.
Exactly. It represents technology, efficiency, better management, and deregulation. Things like our digital public infrastructure, UPI, ONDC, the India Stack, and GST are making the whole system more efficient. It means we can produce more output with the same amount of capital and labor. The survey's big argument is that A is rising, and that is why our potential is now 7%. We aren't just working harder, we are finally working smarter.
This answers 2015 CSPQ90 perfectly, doesn't it?
It's a textbook answer. That question was about capital augmenting versus labor augmenting technical progress. The solo residual approach used here in the survey proves that India is undergoing a structural transformation where efficiency, which is a form of capital-augmenting technical progress, is driving growth. It validates the government's focus on digital public infrastructure as a core economic driver, not just a social service or a convenience.
Finally, the survey wraps up the chapter with a nod to a later chapter, Chapter 16, and this concept of strategic indispensability.
We circle right back to where we started with economic statecraft. The goal, the survey argues, is to move from import substitution, which is defensive and protectionist, to strategic indispensability, which is offensive and confident.
What's the fundamental difference in mindset there?
Import substitution says, I will make this TV myself, so I don't have to buy it from you. It's an inward-looking strategy. Strategic indispensability says, I will design and manufacture this semiconductor chip so well and so cheaply that you have to buy it from me.
You become essential.
You become a node in the global supply chain that the world cannot ignore. You become indispensable. You become the +1 in the China +1 strategy everyone is talking about.
So after this entire deep dive, what does this all mean, if you had to sum it up?
It means the Indian economy has, to a large extent, effectively decoupled from global fragility. While the rest of the world worries about tariffs, recessions, and bursting bubbles, India is being driven by its own internal engines: domestic consumption, robust investment, and a structural upgrade in productivity. We are building our own momentum.
Here is something to mull over, a final provocative thought for you to take away. The survey suggests our potential growth is now 7%, largely due to efficiency gains from digital infrastructure. But it also warns that the global AI boom might be a bubble. So here's the question. If that global AI bubble bursts, does India's real economy, built on steel, cement, roads, factories, and consumption, become the ultimate global safe haven?
That's one possibility.
Or, since we are actively integrating into global tech supply chains to become indispensable, do we get dragged down by the sentiment shock anyway? Are we building resilience? Or are we just building a better, stronger connection to a potentially sinking ship? That is the billion-dollar question for FY27.
That is the risk of becoming indispensable. You become connected.
Yeah.
You cannot be indispensable and isolated at the same time. It's a paradox we'll have to navigate.
Thank you so much for joining us on this deep dive into the economic survey. This was a marathon, but hopefully you now feel like an expert on Chapter 1.
And a humble reminder, if you are capable, please join the paid membership on YouTube. It supports us directly and, honestly, it keeps the lights on and allows us to do this kind of work.
Don't forget the free notes and PYQs on Telegram. And for our Legend members, the premium content and model answers on Discord. We put a lot of work into those model answers.
Like this audio, share it, and leave a comment. Let us know which PYQ linkage surprised you the most. Was it the Pink Revolution or the FRBM analysis? We'd love to hear from you.
See you in the next deep dive.